The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good Wednesday morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN. We got the CPI number out this morning in the market, digesting it in stride so far. We got higher prices across the board right now with green on all four indices. S&Ps right now, drilling down to a 5-minute chart. You see the volatility around 8:30. We actually did spike to a low of about 54.50. Right now, we're positive by about 10 points in the S&P, trading at 54.68. NASDAQ 100, pretty similar action. We charged higher yesterday. We are higher by about 0.25% right now, up by 43 points, 19,148. The Dow barely in the positive by 20 points, 39,909 on the futures. And we got the Russell right now. How about that spike on the Russell? All the way up to 2140, down to almost 2105. We're trading right now at 2116, positive by more than 0.5%. We jump over to commodities. Crude right now, back above $78. We were just below that price level coming into about 6:30 this morning. We're positive by 29 cents at 78.64. You have gold, negative $2. You see a little volatility around those numbers at 8:30 on gold as well. We spiked to 25.19. We're back to 25.05 right now in that gold contract. And we jump to notes and bonds. A little volatility as well. And with the numbers on CPI, and we're going to go over those in a moment, you have a little bit of lower price and higher yield, even though all expectations are, writings on the wall, that this gives the Fed the ammunition, at least if the numbers keep lining up, for a cut coming down the line in September. We get the 10-year yield, 3.85%, the yield right now on the 10-year, 3.85%. All right, let's jump over to the numbers. Core U.S. inflation eases for a fourth month, and as Bloomberg puts it, sealing a Fed rate cut. I was listening to some discussion this morning, and the only thing they were talking about is whether they bring it with 50 or 25. Nonetheless, we have core CPI, which excludes food and energy, coming in at 3.2%. That was right in line with expectations. Monthly, 0.2%, right in line as well. The headline number, here we are. Here are the numbers I want to get to. So core comes in at 2.9. We were looking for 3. Excuse me, I'll do that again. Headline number comes in at 2.9. We were looking for 3. Core comes in at 3.2. We were looking for 3.2. All the numbers come in line, except for the headline number comes in at 2.9 versus 3. So we're either flat or light under the number that the market was looking for. And so I think it's just a little bit of a breath of relief for the market in terms of we stay the course, and the course right now is cuts. Right? The only thing that bucks that trend is if somehow we see a reversal of this inflation, and you're not going to see a reversal with where we are right now. Now, jumping over to the journal, where are we? Here we are, because I liked how they have this on the front page of the journal right now, online that is. Look at those numbers in terms of the decreases, and look at the trajectory of the core number, right? We're at 3.2, but we are dropping like a rock, man. You back it up. Yeah, they don't have the exact dates, but we are dropping like a rock. Now, overall, a little bit stagnant to where we are in those numbers, man. But it is interesting nonetheless. Now, where do those numbers come from? Housing costs drive most of the monthly gains in the U.S. CPI. Pretty interesting where we are, right? What's going to happen when the Fed begins cutting, which should provide greater demand in housing? You have greater demand in theory, in economics. You have a greater demand curve. That's going to shift the price higher where demand equals supply. And you have housing costs driving most of the monthly gains in the U.S. CPI. Now, housing is a much larger component of CPI than it is PCE, which is the Fed's preferred inflation gauge, and that's one of the reasons why they prefer the PCE, because housing has such an impact on CPI versus some of the other impacts that still matter in our lives, which are in PCE. But housing uptick drives most of the monthly CPI, as they put it here. And yeah, excuse me, All right, and this is updated since I was looking at it. I'll pull those ones. Yeah, you do have a pickup in Supercore services. Okay. Yeah, labor costs going up there. There's Supercore services. Not exactly dropping like a rock, right? Pretty interesting where we are right now, sitting at almost 4.5% on the Supercore services there. And there are pockets, pretty interesting, right? New York, Newark, New Jersey, Metro, and the Dallas area still dealing with inflation in excess of 4%. What's going to happen is, when you're seeing pockets of real estate accelerating, that's going to drive CPI costs higher. And it's kind of like a double-edged sword, right? For a while, Florida was remaining hot for CPI. And I was joking with friends that, it's remaining high because rent owners' equivalent rent was going up, etc. And really what was happening was the value of our properties were going up. And so it's kind of a muted conversation when you're dealing with rapid inflation as a result of the appreciation of your properties. Not exactly the same type of inflation we've been dealing with for 4 years or so. All right. Yeah, look at that annualized core CPI. The 3-month annualized core CPI has fallen to 1.6%. This is a very real case that we don't need to be at 5.25 to 5.5%. Now, I was getting ready to do the show today, right? And check out this one. Okay? This is a great visual representation. I'm going to zoom in a little bit of CPI versus PCE. Okay? And the way you want to think about this is personal consumption expenditure includes items that you consume, the personal consumption, but you might not actually end up paying for. And the best example of that is healthcare. So in the PCE, you have the food category in purple, okay, which is 15% in CPI, 13% in PCE. But check out housing. Housing in the CPI is 32%. I think on core, it's like 40%. Okay, these are headlines. In the PCE, it's only 15%. And that's because what happens is that healthcare is a much larger component of PCE because you consume healthcare as a consumer, yet you're not paying for it as a consumer price because many people receive healthcare as part of their job. So you have your employer paying for your healthcare. Meanwhile, that still matters because you are consuming it. So if the employer is paying higher costs, what are they going to do? Well, they're probably not going to give you as big of a wage hike, right? They're going to contribute to things that are going on in an inflationary environment. Healthcare, 21% of the PCE. Housing, only 15%. Compare that to CPI, housing 32%, healthcare only 9%, right? Then you get into PCE, you got financial at 8% versus 3% in CPI. Nonprofits, 3% in PCE versus non-existent in the CPI. And then it shifts a little bit. And then you have another category about 18. Energy, a slightly larger category in CPI. But keep your eye on those because what does the Fed prefer? The Fed prefers the PCE. Don't be too worried about housing as they come out of here. Now, things flare, but we'll finish this conversation up. We got a lot to talk about markets and higher prices. Stay tuned, folks. We'll be right back.
If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
In the world of trading, only a few names stand out like Larry Pesavento, a pro's pro with over 50 years of experience. Larry has seen it all. A former Chicago Mercantile Exchange member, Larry has authored 10 books and trained over 1,000 traders with his unmatched expertise. Introducing Fibonacci 24/7, Larry Pesavento's daily trading service that turns the complexity of markets into opportunities. Published every Sunday, receive a comprehensive report packed with detailed commentary, charts, and videos that illuminate the patterns shaping the markets, with updates throughout the week exclusively for subscribers. Whether through charts or videos, Larry's analysis is your roadmap to navigating the markets. You can sign up now at TFNN.com for just $97. And with all TFNN newsletters backed by a 30-day money-back guarantee, you have nothing to risk. For all the details, visit TFNN.com. You'll find Fibonacci 24/7 right under the newsletters tab.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN has launched the Tiger Zen, hosted at Discord. TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger Zen, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
This portion of the Morning Market Kickoff is brought to you by Direxion's daily leveraged and inverse ETFs. Whether you're a bull or a bear, you choose the direction. Visit Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC.
Welcome back, folks. We have the Dow rolling over to slightly negative prices, off by 2 points right now. You got the Russell up by 7, S&P's up by 7, trading at 54.66. And jumping back to some of those CPI numbers real quickly. I mentioned shelter. Here we are. Oh, come on. Here we go. Shelter inflation edged higher again. 0.4% on the month versus 0.2% in June, and overall supercore services 0.21% on the month, quite moderate but higher than the small drops registered in May. Overall, the data is consistent with the deceleration in inflation from the levels of the past few years, but suggests that price growth is not suddenly juddering to a halt. There doesn't seem to be anything here that would scream out for a 50 basis point next month, which is probably why short-end yields are nudging a bit higher. And that is a macro strategist, not familiar, but nonetheless in New York. And yeah, I would say that 25 is in the park, but 50, I think you're pushing it. I don't think this is an emergency situation that usually you would go to 50, etc. I had one more I wanted to get to up here. Yeah, they talk about a bunch in here. Supercore services. And what else do we have in there? All right, real quick. Finishing up, though, when we were talking about... Oh, come on. Where are we? Here we are. The weighting. So housing, shelter, right? Up more than the market expected. A much larger component of CPI versus PCE. We get PCE later in the month, and PCE is what the Fed prefers. And where is the cost going up the most? The cost is going up the most in housing. So not going to be as big of a factor when it comes to the PCE. Later, as we transition to More data throughout the month, but nonetheless, we see where we go. But yeah, it's looking like it's going to line up. Now, the one thing I was going to try and get to is the market is pricing in about 4 cuts right now. See if I can find it one more time. They're looking for about a full percentage point of cuts. So here's where they start talking about it. Traders scale back expectations for a 50 basis point reduction in September after July inflation data comes in with forecasts. Rate cut bets in basis points. Seems like the market is basically split right now, favoring 25. But check it out. You go to November and you're at 69. You go to December and you're at a full point, okay? Futures trading still shows a full percentage point of rate cuts by the year end. There's just 3 meetings, folks, September, November, and December. So the market right now is pricing in a situation where the Fed needs to come in and rescue this market with dramatic cuts in almost an emergency situation. Because if it's not an emergency, there's no reason to go 50. All right, if they really start to get worried, then maybe they start going 50. But the risk there, okay, we're already dealing with a hot shelter market. There are pockets of this economy that inflation could pick back up, and that's what they're worried about. I mean, can you imagine, folks? We're all familiar with it, right? What happens? What happens when the Fed really starts bringing it with the cuts, and we get back to an environment where home mortgages are 3.5%, 4%? Now, we got a long way to go, okay? That's only if they start cutting dramatically, all right? But even this morning, there it is. We got another mortgage article about rates. This is this morning, 7 o'clock. Mortgage refinancing surges 35% in a week. Interest rates hit lowest level in over a year. Fell slightly, 6.54% from 6.55. Now, here's what I'll say about this, okay? You have the 10-year yield currently sitting at 3.85%. That 10-year yield is factoring in that cuts are coming down the line. Okay, we have an overnight lending rate at 5.25% to 5.5% right now. Traditionally, historically, mortgage rates have been about 2% above where the 10-year is, give or take. It varies. It's been higher recently, okay? But that's why maybe when you had the 10-year approaching 5%, we had mortgages going between 7 and 8%. Right? We now have the 10-year back at 3.85%. You could make the very real case, folks, that mortgages are on their way back under 6% right now. Okay, if you got the 10-year at 3.85, companies will figure out how to push out mortgages at 6% if things stay where they are, and that's where the trend is moving. Now, what happens if they go lower, though? That's going to be the conversation, right? What happens if they go lower? We have a full percentage point of cuts priced in within the next 3 meetings. Well, that's already priced into the 10-year. Okay, we need to go further than that to bring down the mortgage rates. But if you really get a weakening in the economy, the point being, the Fed's at 5.25% to 5.5 right now. If they ever bring things back down to the point where you get mortgages under 5%, not outlandish, you're at 6.5 right now. You get a 4 handle on mortgages, watch out, because that is like opening the spigots of economic activity, because of the amount of people who are, in one case, unable to move. Okay, that's going to free up. Imagine you say to yourself, man, I thought I was going to be tied to this house for 25 years. You're telling me I can sell this starter house, buy a different house, lock in a mortgage, use my equity, and not pay a substantial price, let alone the people you're going to have who refinance. Okay, the refinance share of mortgage activity increasing to almost 50% of total applications from 41%. Yeah. There is a lot of equity in homes right now that is inaccessible, okay? And the financial community has been trying to figure out ways to allow people to access that equity in their homes without refinancing, because nobody wants to refinance when mortgages are at 6.5% and you have a mortgage at 4%. But when you start talking about that you're at 4.75% for a mortgage, and meanwhile, all you got to do is refinance from 4 to 4.75%, and you might free up $100,000 or $200,000 of equity in that home that you have in there. That's what we're on the verge of, and that's what the Fed is afraid of. Okay, that is one component that the Fed is aware, and that's why their rates matter. They start bringing down the rates and they start cutting. You're going to see housing prices rise. You're going to see people gain access to the equity in their homes, and that is, yes, a big factor, of course. But yeah, you're at 6.54% right now. We got the 10-year at 3.85, and so mortgages probably on their way back to at least 6%. We'll see where they go from there. But yeah, you got that number out there. You got CPI prices moderating right now, and you have shelter prices, one of the hottest parts of this market still. But shelter, not as big of a component of the PCE out there. So we'll see how that plays in. We jump around to some of the Magnificent Seven. You got Amazon shares. They're going to be up by more than 1% on the open right now, trading at 172.13. We jump over to Microsoft. They're up by about $1 to 415.16. We jump over to the big dog, Apple. Apple right now, trading basically flat, 221.18. We jump over to Tesla, positive by about $1 to 209 right now in the pre-market. We jump to NVIDIA shares. It's a rocket ship, folks. NVIDIA up to 119. It was trading at $90 last Monday. 119 for NVIDIA. Stay tuned, folks. We're coming back. We'll talk some more equities. We're coming back for the opening bell. Don't go away.
The consistency you're looking for is closer than you think. 1 or 2 adjustments are usually all you need to change your equity curve from red to green and keep it there. Come join Larry Pesavento live to learn what separates the winners from the losers. Join Larry Pesavento on the 2nd and 4th Friday of every month for 3 hours of live trading from 9 a.m. to 12 p.m. Eastern Time, where Larry will show you the market setting up and, most important of all, the state of mind of a winning trader. By watching Larry trade, you'll learn the Fibonacci levels, you'll learn how to apply A to B to C to D trading patterns, you'll learn trade management, pattern recognition, and much more. Join Larry Pesavento Friday, July 12th and Friday, July 26th, 9 a.m. to noon Eastern Time for 3 hours of live trading. For this month only, use promo code LarryJuly24 at checkout to save $50 on your first month's subscription. For all the information and to reserve your spot today, visit the front page of TFNN.com.
If you spend any time online researching trading techniques on how to begin your trading journey, you've no doubt come across many folks who push Forex trading as a way to make big money quickly. Unfortunately, there are equally as many stories of these so-called Forex professionals just looking to make a quick buck off aspiring traders without actually teaching the ins and outs of the Forex market. This is what sets Teddy Keckstack's The Tiger Forex Report off the riffraff. Every Monday, former Chicago Mercantile Exchange member and author Teddy Keckstack releases his Tiger Forex Report newsletter, where he dives into the complex world of Forex and takes time to actually teach you his methods that have made him so successful in the fast-paced and rewarding world of Forex trading. Furthermore, all subscribers receive access to archived live streams of Teddy's, where he provides university-level education to help you in Forex trading. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Forex awaits.
The stock market is a delicate, interconnecting web of commodities, equities, and trader psychology. When one string of the web is pulled, it has a ripple effect across the broader market. This is where opportunity lies. But how are you to gather all of this information into one cohesive model when you're already spending your energy looking for any possible trade opportunities? Luckily, you don't have to worry about that, as Tom O'Brien has brought all important market news to you in one single newsletter, Market Insights. Market Insights provides a daily overview of what's happening in the indexes, bonds, gold, and more. Follow along with Tom daily as he analyzes the components that affect the overall movement of the stock market, giving insight into how each one plays either a bullish or bearish role. Tom also analyzes specific equities that he believes has the potential to make huge returns, and his track record proves his analysis right. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Don't let the market leave you in the dust.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. We got markets open. You got the S&Ps right now up by about 7 points, trading at 54.67. It seems like this market just takes it in stride right now. The inflation numbers for CPI pretty much in line, softer if anything. And we look forward to the September meeting when the market is basically caught with a 50-50 chance of 25 to 50 basis points. And I'm leaning towards 25 because there is not the rapid fear in this economy right now that some would like to believe. And when you have inflation still running well over 2%, okay, where that is debatable, but well over 2%, you can see the risks that are present in this economy on a CPI number, on a PCE number, with pockets of inflation that could reignite if they cut too quickly and spur the economy at this price level. But markets, yeah, we're sitting pretty, man, up by 10 points at 54.69. What else you got going on? Mars, they're going to be buying Kellanova. $36 billion. $36 billion. How about that, man? Now, where is this thing right now? Oh, look at this. So right now, it's only valued at a market cap of $27 billion at this pop. So the market's saying maybe we're not getting done just yet. But nonetheless, family-owned giant Mars. Yeah, they're going to buy Kellanova, which was spun off from Kellogg's recently. And yeah, Pringles, Cheez-Its, the whole deal. Mars is going to control it. $36 billion, biggest deal in the packaged food industry. Mars is going to pay $83.50 a share, and you're trading at $80 right now. Okay, so that's as of August 2nd. Yeah, there you go. That makes more sense, right? So they reported that deal on August 2nd when you were at about $62. They're going to pay $83 right now. You get the pop from 74 to 80, still a few dollars away from where that transaction technically closes at. $83. They're getting this, above anything. Look at that. From $47, they're paying $83. Man, if they wanted to buy it, they should have come in here, right? Maybe that's where they started to think about it, and it took them until a year later, when it was at about 57, and they get it at 83. Quite a premium from where this equity has been. They had the earnings on July 29th. They were probably already in talks. But it is interesting. They buy it at 83, and this thing was chopping around at about 55 for the better part of 6 months, almost, predating that acceleration you had just beginning at the beginning of this month. $83, not bad, man. Yeah, the deal comes as sales growth at U.S. packaged food companies, including Heinz, Mondelez, and Hershey, slows due to budget-strapped customers opting for cheaper private labels instead of pricier branded items. Is the Fed listening? That doesn't sound like a strong economy. But it dwarfs their $23 billion takeover of Wrigley in 2008. And, I mean, look at what you're going to have here. Not expected to face too many antitrust roadblocks due to the limited overlap between the offerings of the two companies. Kellanova is going to become part of the Mars snacking. The good old snacks. And I will tell you, man, Tommy loves Pringles. Those are his one snack, and he's always got to have a meal first, right? That's kind of his treat. If he wants one, maybe a couple times a week or something like that. The one thing I will say, though, folks, I'm not sure if you're aware, Pringles are not actually potato chips, and legally they can't even call them potato chips. Did you know that? Yeah, they're not even. That's how processed they are. All right, and I love them. Don't get me wrong. All right, give me some good. We like cheddar right now. Tommy's on a cheddar Pringles kick, but boy, some salt and vinegar Pringles, right? What do you got out there? You got some good salt and vinegar, all that stuff. Yeah. And Al, if you could take a look, my head's getting chopped off on the YouTube. Come on, pal. Maybe we can fix that one. I'm not sure. Maybe we got to fix it. My hand's out of there, too. We're going to fix that, folks. I'm not sure why that's happening right now. But we got my hand and my head out of there, Al, if you can try and fix that for me, pal. But, yeah, can't even call them potato chips. And the reason why is because they're basically a cornstarch meal that is compressed to the form of a potato chip, and that was a big legal deal. You can't actually call them potato chips if they're not just sliced potatoes. Yeah, pretty interesting as that plays out. $36 billion, man. Pretty remarkable. You look at, they bought, I mean, what is Mars valued at right now? Quite a family-owned company. When you're talking about buying Wrigley in 2008 for $23 billion, now you buy Kellanova for $36 billion. Nice little family-owned company producing M&Ms out there. Yeah, to say the least. Nonetheless, you got Kellanova trading a little bit higher today. We jump over to Google. So they demoed their Gemini. All right, they demoed this yesterday. We jump over to Google shares today. They were a little bit lower yesterday. They had a couple snafus, but overall, and there you see some of the acceleration. That was probably when they were going live and they had a couple snafus. I know one of them froze at one point then when they were talking to their demo. Let's see. Yeah, the demo failed, freezing up and displaying an error message. He tried again with the same result. They swapped phones and then it worked. These things happen. They're going to perfect these problems, folks. They are. But one example they gave here is you can see how, and this is going to be cool. I've already done it with my phone on Apple. You can see you search for something, and it searches for words within a picture or something like that, right? Or it searches for locations where a picture was taken. It searches in ways that are very difficult for a human or time-intensive for a human to do. One example, they said, he took a photo of a concert poster and asked Gemini to check his calendar to see if he's free the night that Sabrina Carpenter is playing in San Francisco. Now, you can do that yourself, right? You go in, you look at the date, but it's doing it all itself. It's going to be this rapid acceleration of productivity that's going to occur. Now, that is the one where the demo failed a couple times. He got it to work eventually. But these are some of their phones that are going to start getting shipped, and Apple's going to be a competitor as well, man. Yeah, in June, Apple presented a pre-recorded video rather than a live demo, though, right? This was a live demo. Apple just had a pre-recorded video. Where's their live, okay? And Apple talked about similar stuff, though. Siri's forthcoming leap into capability, taking actions, and understand context under its new AI system called Apple Intelligence. But nonetheless, Google, they did theirs live yesterday. So give them a little recognition for doing it live because Apple couldn't do it live. But guess what? The market's saying, no, that didn't go as well as we hoped. You're down by 1.7% for Google today. And you got Apple shares right now positive by about 0.1%. We jump over to Amazon. They give back some of the open, up by about 0.5% for Amazon shares. As we got the market barely hanging on to gains. We jump around to commodities. Gold. Gold gives it up a bit. We're down by $14 right now. On a bigger picture, gold has been behaving pretty well. I mean, look at this weekly, right? This weekly, you accelerate higher, you build a base between about 2,300 and 2,450, and now we're building another base kind of right above that price level, 24.94 right now in gold. We jump to notes and bonds, and we're sitting right where we were coming into that number, basically. Yeah, right where we were at 5 a.m. this morning. You were a little bit lower from 8:30, but nonetheless, we have yields right now sitting at 3.85%. 3.85% on the 10-year. And we jump over to the dollar index. You have a weaker dollar at 102.41. And that's a perfect segue, folks. We're coming back. We're going to talk to our man Teddy Kegstad for the next segment. Coming back. Don't miss it. Always great stuff with Teddy. We're right back in minutes.
Are you ready to take charge of your financial future? TFNN is your gateway to the world of trading and investing. Whether you're starting out or scaling up, TFNN empowers traders and investors of all skill levels with top-notch investing systems, strategies, and techniques. It's time to protect and grow your money with insight you can trust. Join us live Monday through Friday during market hours for exclusive content that moves with the markets. At TFNN, we bring the trading floor to you. Our seasoned hosts are here to answer your calls and questions live on the air. Check out the Tiger's Den for just $1 and follow us on YouTube and become part of our vibrant community. And remember, at TFNN, we're so confident in the value we provide that we offer a 30-day money-back guarantee on all new premium newsletter subscriptions and services. You have absolutely nothing to risk, so why wait? Tune in live to Tiger TV and transform your trading journey, because when you know better, you invest better. Join us and experience the difference today. TFNN, educating investors.
Many trading newsletters attempt to focus on a narrow set of equities or commodities. While this works for some, it oftentimes misses many opportunities that possess huge gain potential. But how is an independent trader supposed to scan the entire market looking for these hidden opportunities? One simple answer: the opening call newsletter. Basil Chapman, developer of the Chapman Wave trading methodology, has been trading the markets for longer than most trading influencers have been alive. And over that time, he has honed his methodology in order to accurately call movements in a wide range of equities, from semiconductors to uranium to key indices and so much more. Basil is old school, taking the time to educate the trader while also giving his insights into key indices, selective stocks, and more. Opening call subscribers also receive access to dozens of educational live streams that can be accessed at any time for your edification. All first-time subscribers receive a 30-day money-back guarantee. So ignore the pop trading influencers and start learning time-tested technical analysis.
For traders who crave risk, Direxion's daily leveraged and inverse ETFs provide opportunities to magnify short-term perspectives with up to 3 times a daily leverage, utilize bull and bear funds from both sides of the trade, and trade through rapidly changing markets. These are highly leveraged ETFs with daily resetting designed for short-term trading, not long-term investing. Whether you're a bull or a bear, you choose the Direxion. For up-to-date pricing and performance, go to Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We jump around. We got the S&Ps right now slightly in the red as we rolled over, and we roll over slightly. I mean, for some context, and I always use that word context. Context is so important. Where were we at the beginning of yesterday? 53.70. We're trading at 54.54, negative by just 5 points right now on the S&Ps. And as we do every Wednesday at 40 past the hour, we're going to talk to our man Teddy Kegstad, folks. You can head on over to the front page of TFNN. Teddy's got his outstanding newsletter, the Tiger Forex Report, with new issues each week. You can check that out under the newsletter tab at TFNN. You can subscribe for $97. Comes with a 30-day money-back guarantee. Outstanding reports every Monday morning. And then he's got updates throughout the week when warranted. And if you're looking for a couple of great webinars, don't miss the webinars under the services tab. Capitalizing on time with calendar, stock options spreads, and Japanese candlestick pattern stock and option strategies. Both of those just $97. And when you purchase those webinars, folks, they're always on your page. You can watch them as many times as you like. And I know we got Teddy on audio today. No video, but that's all right because we always got action on Wednesdays. Teddy Kegstad, good morning.
Good morning, Tommy. We've got a little action in the currency markets today off the CPI number.
We sure do. So what do you think about, the general conversation, I guess? Because today, of course, we get CPI. We got retail sales tomorrow. All the talk right now, Teddy, is about where the Fed goes in September. And why don't you give us a little feel for what you're thinking, if you could?
I think the CPI number is mediocre at best. I don't think it's really, if we would just look at it on a 1 month basis and considering the trickle that it's kind of pushing right now, it sets them up for juicing the election in September with the rate cut. I mean, the market's already factored in at least a half a point already. It has already since, basically, 4 months ago. And you have to look at where are we at right now? We're where we started the year off. If you look at the dollar index and some of the major currencies like the euro, we're right where we were basically on January 1, considering everything that's happened, which hasn't been much, as far as encouraging economic data in that time frame. What we have is this short-term little drift, and the thing is that the most major components of inflation aren't counted in the CPI. Food and energy is something that impacts everybody. So those components, we know that those aren't there. It's a very diluted number. As far as what it's going to do, and is cutting rates actually a good thing right now? I think cutting rates is one of the worst things they can do. We need to at least stay stable with rates right now. I think that would be the smartest thing, especially for the real estate sector. If we start to cut rates, sure, it makes financing a little bit more affordable, but that may not necessarily be the best thing for the real estate market. So I think it's a trap. And I would say that even if they're going to cut rates in September, I really highly doubt they're going to do a half a point. To do something like that would be acknowledging that they were way behind the curve. And I can't say that they really are, because rates are actually historically still ridiculously low and should be higher than they are right now. So I don't know how much wiggle room they're going to try and make. I think it's sensationalizing the outlook of the future to think that we're going to have rates as low as we had, a few years ago. Not that the Fed wouldn't do it and couldn't do it, but remember that that's also one of the reasons why we have such high inflation to begin with. It's not just printing money; it's low interest rates. So if we start cutting rates, the quantitative easing becomes the next thing, which is only going to drive inflation even more. So I would say I would be very cautious as to, especially if you're trading the interest rate markets, we get a rate cut, that may make yields actually go up.
I appreciate the take, and I agree with the 25 versus the 50 for a variety of reasons that you kind of stated in there. In terms of, we have, I was reading, recently, and the term stuck in my head today, recency bias, in terms of we're all so used to rates being so low for so long, but that's not really how things worked. And just because they were so low for so long, we kind of have this recency bias that we have to go back there. But in actuality, that's not how things work, in the broader scale of where interest rates should be in a healthy economy. We should not be at 0%. We shouldn't be at mortgages at 3 and 3.5%. In light of the economic growth and this economy that we have that's pretty resilient, even with unemployment rate at 4.3, historically it's a gangbuster number, man. Not exactly indicative of emergency cuts necessary. I'm glad you mentioned real estate. Could you elaborate when you said, because I was going to ask the question today, what happens? I think they stated in the CPI 90% of the gain in CPI was in shelter costs. Now, there's volatility in these numbers, and you mentioned that CPI has a different basket, not exactly indicative of everything going on. But it is interesting that even shelter in that component. But you mentioned that if they do cut, it might be tough for real estate. How do you go there? Could you elaborate on what you think that? Because I was going to ask you, what happens if we do get those cuts? Does that put a bid under real estate? Do people begin to refinance? Is that one of the fears they have of inflation reigniting? Could you elaborate when you said, if they do cut, maybe that would be a tough one for real estate? Or could you talk a little bit more about that point?
Well, here's the reason I think it's going to be a tough thing for real estate is that people think that it's going to be a buyer's market because of lowering rates. Actually, that's not going to be the case. What it's going to be is it's going to be a seller's market for the people who are trapped. And the reason I'm saying that is I can't speak for how real estate is in Florida. I can speak for how it is in California, Illinois, and a couple other states that I active in or know people who are very active in. And one thing I know is very common for all of those states is that if you have commercial real estate, especially, it used to be you could not raise taxes more than once every few years. Now you can raise taxes not only once a year, but sometimes twice a year. Just in the Chicagoland area, commercial real estate in most of the Chicagoland area has doubled in the past year. So if you were running at 20 to 30% more taxes being added to your costs every year for 2 years prior to that, 3 years prior to that, and then you double it, that means that in the course of 3-4 years, your property taxes have gone anywhere up of 200%. So now if for commercial real estate, the nice thing about commercial real estate is you can depreciate, as you know that. But that only goes so far. You can only depreciate to zero. Once you get to that, you no longer can write off against your profits, and your taxes now, considering that they've doubled at the very least over the past couple of years, means that if you want to stay in Illinois, you already know your tax burden. You've already absorbed decades of tax increases within just a couple of years. It's not sustainable. So that means that if you want to get out, if you're a smart business person that owns real estate, especially if you've depreciated it, you want to dump it, and you can. So you're going to that's going to lower the prices. So people will get suckered into the trap. They'll be able to buy commercial real estate and other things a lot easier because of the lower interest rates, but then they're stuck with the tax trap. how do you get out of it? I remember back in the early 2000s, right before the real estate bubble, when I lived in the Gold Coast, I sold my condo in one of the nicest areas in the city because my taxes and assessments were more expensive than what I could rent the place out for, and I owned it. I didn't have a mortgage. So I mean, that's a reason to sell a piece of property right there, And I think that's what we're heading into this fall, especially if they cut rates.
Can you hang with us for the break?
Sure.
All right, we're going to come back. We'll talk a little bit of crude. All right, we'll take a look at that dollar index as well, but I want to take a look at that crude contract as well. We'll take a look at gold. Stay tuned, folks. We'll finish up the conversation with Teddy. We'll be right back.
The Gold Report. As a precious metal, gold is still king. It continues to hold the most effective safe haven and hedging properties across the global major trading hubs of the London OTC market, the U.S. futures market, and the Shanghai Gold Exchange. The Gold Report. Tom O'Brien publishes his weekly gold report every Monday morning for subscribers, consisting of coverage of the XAU, HUI, GDX, the dollar, bonds, the South African rand, as well as 25 different mining equities with specific buy-sell recommendations. The Gold Report. New subscribers get a 30-day money-back guarantee so you have nothing to risk. Subscribe to Tom O'Brien's Gold Report newsletter now at TFNN.com.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
The reality is that navigating financial markets can be risky. Markets can be chaotic and difficult to understand. Having the latest market advice can help you turn this chaos into a key for creating winning trades. At TFNN, we understand that it can be hard to find reliable market news. That's why each of our market experts offers their very own market newsletter, a must-have tool for every trader out there striving to find an edge in today's markets. TFNN newsletters cover every aspect of the markets so you can analyze the market before you trade. Try any of our great newsletters risk-free with our 30-day money-back guarantee. Just visit the Newsletters tab on the front page of TFNN.com. TFNN, educating investors.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. We got the S&P's negative by 2 points right now, trading at 54.56. A little bit of negative action on the opening bell, and we've just been chopping around that price point. We're talking to our man Teddy Kegstad, folks. Don't forget, check out Teddy's Tiger Forex report under the newsletter tab. He's got a couple great webinars under the services tab. And we had to talk a little bit of crude, and we'll talk some yen maybe, and I know that ties in to some degree, but what do you think about crude, Teddy? We hit $80 on Monday, it was, and we're trading at $78, but a little bit of higher price recently off those lows. What do you think of the crude action?
I liked how we topped out on Monday and yesterday with a double touch around just over $80 a barrel. Nice little pullback yesterday and today. I think that we have an interesting situation forming in crude, and we have a trade possibly. I think that today you're probably going to see it pretty stable, and maybe close around. If it stays a little bit lower today and especially tomorrow and doesn't really sell off in a big way, I would look for a recoil reaction and a challenge of the highs from yesterday and Monday. And if we can get a breach of that $80 a barrel level again sometime between tomorrow and Friday, I would say that, and especially a close above there, that would be a good buy signal, and that would probably set us up for a rally back up to, I'd say, 83 to 85 bucks a barrel. I don't know if we can get much higher than that in the short run, but I think that right now, if the market's in a bear trend, the top yesterday and today pretty much sets the high for the correction. So if this was a profit-taking rally, it should be done. If it continues higher and gets a close, especially now with this kind of, it would be another wave formation, setting the market up for, even if it's in a consolidation, we're going to be riding the higher upper part of the range, I think, from 80 to 85.
Nice. I like it. And how about the dollar yen? Chopping around 147 for the last 5 days or so after that acceleration to below 142. What do you think about the dollar yen sitting at this 147 price point? We rolled a 146.99 as I say that.
Sure. Well, you know what? We're above our monthly directional pivot level that we have in the Tiger Forex report at just around 145 area, and we're below the 150 critical BOJ threshold level. I think we're going to chop around in there for a little bit, but I would say if crude especially gets a big catches a bit, and if yields even rally a little bit, I think you could see the yen above 150 again soon.
Folks, check out that Tiger Forex report. Lots of great actionable info. You heard it from this. Teddy, thanks so much. We'll talk to you next week.
Thank you. Take care.
Folks, stay tuned.